Hi, and thank you for tuning in. I'm Vanda Crowsley. I'm with eXp Realty, and I wanted to introduce you to Eric Schmidt. Eric is with Inland Home Mortgage, and he's going to talk about investment properties 101. Because as we know, investment properties are the future, and they're not making any more land. So get you a piece of that land while you can. So without further ado, I introduce you to Eric.
Hey, Vanda, thank you for the introduction. I appreciate that. And you're right. We can manufacture a whole lot of things, but we can't manufacture dirt. So
Nope.
we got to jump on it when we can. My name's Eric Schmidt. I'm with Inland Bank and Trust. I've actually been in lending for just over 20 years. Based on the gray in my hair and my beard, it looks like I've been here for about 55, 60 years, but that's just because of the industry. It does that to you. But anyway, I want to talk to you today about investment property. It is actually a topic I really like and enjoy. I have a lot of friends and family that do investment property, and I want to help educate other people and show them how to start to grow their investment portfolio. The presentation today is actually going to be talking more about kind of dipping your toe in the water and your first starts to the investment property. If we have anyone that's on the call that is a little bit more seasoned or has been doing it for a while, um, they already maybe know some additional tricks of the trade to help you grow your investment portfolio a little bit quicker than what this process is. But this is a great way to start and start expanding your interest in real estate. So without further ado, let's go ahead and jump to the next slide. And what I have here is a quote actually from one of our famous Shark Tank people, Barbara, who's a real estate guru within the industry. And what she says, and it's actually kind of fitting today, is a funny thing about real estate. When it comes back like gangbusters. I think we all know that today, if you've been following the real estate market more than anything else. People writing offers 10, 15% over asking price, paying cash for homes, and trying to uh, trying to keep things, trying to buy into the house and the investment properties, and having to pay higher than what they did before. But that's okay. That is a good thing about real estate. So one thing I want to talk about when we start going into this is I like to go over some of the advantages and disadvantages. Obviously, there's always a lot of advantages and upsides to real estate investments, and but I also like to just point out the downside because any investment there's risk involved as well. So some of the advantages that we do have in real estate is the nice thing about that is when you actually buy the property and you have that mortgage payment and it starts building equity, you actually have someone else doing that for you. So based on your payments that you have and that you're making, actually the equity that's being built by paying down that mortgage, the tenant's doing it for you and it's not coming out of your own pocket. So you get to take advantage of what we call OPM, other people's money. There's also tax advantages to owning investment property. Now, to get the full advantages and know exactly what everything is, you need to check with your CPA and or tax consultant. But there are what they call paper expenses. So in other words, expenses that you don't have to um, pay out of pocket, but it's a depreciation. So it's a paper expense, and you're able to lower your tax liabilities by owning investment property. Nice thing about investment property, it's tangible. Unlike owning a Bitcoin or a stock in Caterpillar or Exxon Mobil, you can hold the stock certificate, but you can't necessarily own, hold, or go tour the corporation. With real estate, it's tangible. You can touch it, you get to feel it, you can walk inside, you can vision what the home looks like today and try to see envision it, what it'd be like in the future. So, and the last but not least, one thing I think is huge that we all need to keep in mind is that 90% of the millionaires became so through owning real estate. So as we look at the multiple millionaires that are out there, 90% of those came from investing in real estate. Now, of course, let's look at some of our disadvantages of owning real estate. One of them that it takes time and money. So when you first start out to buy your first investment property, you have to have a savings built up for your down payment. And it takes time for that equity to grow and for your money to grow. Unlike if you get lucky and you bought Bitcoin when it was $1 a share. Uh, the other thing, it's a long-term investment, so it's something that you're not going to get rich overnight, but within 5 to 10 years, you can really start seeing your net worth grow pretty quickly. It can be problematic, and what I mean by problematic is, give you an example. You're at home, you're watching TV with your family at night, and all of a sudden you get a phone call from your tenant, their hot water heater went out. Well, that's going to have to be something that needs to be addressed immediately. So there is always some sort of reinvestment back into those properties. And last but not least, it's not liquid. So you got to keep in mind, in order for you to get to the value of the property or the equity that you have in the home, there's only two ways to do it. You either come to the bank and you borrow it, or you are going to have to sell that property to get to that, to get to your equity and liquidity of the property. Any questions at this point?
Can I chime in one
Yeah,
second?
please go ahead.
So one
Please.
of the disadvantages when you said people are going to call you if there's a problem is to get property manager. You get
Correct.
property management, pay them 8 to 10% of the monthly, and you're hands off, and everything goes with them, and they don't even have to know who the owner of that property is because everything will go through the property management company.
Yep, very good point. Very good point. So, and that is a great way, and a lot of people do that, and it does make it a little bit more seamless for you. So the other thing I always like to talk about when it comes to investment property is your rate of return. When you go to take your money, whether you invest it into a 401k, a mutual fund, or into investment property, you always are trying to get your highest rate of return possible. So the way that we're going to calculate your rate of return is we're going to look at your expenses versus the cash flow of the actual property. So your expenses when you're buying your property are going to be your down payment and closing costs and cost of improvements if there are any, depending on the property that you're buying. To determine your positive cash flow, what you're going to do is you need to take your gross rents that you're receiving from the property, and then you're going to have to subtract off what they call PITI, which is your mortgage payment, which is your principal, interest, taxes, and insurance. So the way the formula works and the way that I use it is we're going to take your down payment plus cost of improvements, if any, and we're going to divide that by your positive cash flow, which is your market rent or your rent for the property minus the mortgage payment. And that's how you're going to get your rate of return. Now, what I like to do is I like to put some of these examples into more numbers to make them a little bit more realistic. So on the next slide here, I've actually kind of put in just some hypothetical examples of what maybe cash flow could be on a 2-unit property and what a rate of return can be. So give you an example, I have a client who wanted to buy a $150,000 property. They have to put 20% down, which is $30,000. They had to do some improvements to the property because they bought a slightly distressed home. So they had 15 grand into it to improve it. So now we have total money invested of $45,000. Now they bought a 2-flat or a 2-unit as well, and that 2-unit actually rents for $2,300 a month. Now the mortgage payment with taxes and insurance on that particular home were actually $1,150. So your positive cash flow per month on that investment property was $1,150, which is kind of ironic, but it was exactly half. So what we're going to do is we're going to take your positive cash flow, we're going to multiply it by 1 year, and that comes to $13,800. I'm going to take that $13,800 and I'm going to divide it by my money invested, which is the $45,000. So under this particular example, we are getting a 31% rate of return. Now that 31% rate of return doesn't even include any appreciation on the property at all. So it is just simply your rate of return is just simply based off of your cash flow versus your money invested in. And the reason why I typically exclude the value is because we just don't know if we're always going to have a positive increase or an increase in value of the property. And that can change year over year. And you actually won't even realize that until after you sell the property. So I just always exclude that when I'm using my calculations. Any questions?
No, but 31% rate of return is pretty good. Where were
Yeah,
you 20 years ago?
yeah. I mean, if you listen to your Edward Jones and Merrill Lynch experts, they always want to try to get you a 10% rate of return. So we're tripling that today.
I love it.
So some of the basic loan requirements that you're going to have when you're buying your first investment property is you'll need anywhere from 15 to 25% down. Whoop, I'm sorry, I must have jumped a slide there. Now keep in mind, 15% down would require you to carry what they call PMI or private mortgage insurance. Most common on our percentages down is 20. but some banks do, or some programs do require 25. So it just kind of depends on which program we're going to get into. When you are doing your investment property, the banks do like to see 6 to 9 months of what they call PITI, which is the mortgage payment plus taxes and insurance, in what they call the reserve account. Now, that reserve account can be your checking account, it can be your savings account, it could be a 401k, it could be an investment. It doesn't necessarily have to be um, in your checking account ready to go, and you're not going to bring that to the closing table. And they just want to see that, God forbid, something were to happen. There is money set to the side to help cover that mortgage payment while you're trying to get the property back rented because maybe you had a tenant that you had to get out of the property, or the tenant left and you didn't have anyone lined up to rent it right away. The other thing we always do like to recommend is that you have set aside anywhere from 10 to 15% of the value of the property, or that we set aside 10 to 15% of the cash flow of the property, I apologize, into a savings account that's a little bit more liquid. And the only reason why we recommend this, and it's not required, but it's just recommended, is that because after a tenant leaves, there's usually some minor work you're going to have to do to the property, whether it's replacing some of the carpets, painting it, maybe just doing a quick clean out. But it's always good just to have some money set to the side just in case something happens. So that way you're not diving into your own personal cash when that tenant were to vacate the property. The other thing I want to just touch on, and obviously I'm not an insurance expert, but it's definitely something that you need to talk to your insurance agent about, is the insurance coverage for the home. The lender's going to want to see not only your standard coverage to protect the exterior of the property, but they're also going to want you to have what they call rent loss insurance. And what that rent loss insurance is, it's insurance that is designed to help make the mortgage payment just in case the home were to be hit with a tornado, maybe it's a fire. But if the tenant has to vacate the property because of a national disaster or a misfortune, the insurance will kick in and make sure that the mortgage payment is still being paid. In regards to the proper coverage, again, I highly recommend you talk with your insurance agents. There's additional liabilities with owning an investment property, so they're going to give you the proper coverage and direction to go, but just something to consider, or at least make sure that you have when you go to get your insurance coverage. There's a couple different loan types that can qualify, and we are getting pretty close here to the end of the presentation. But the traditional loans that we typically offer would be your Fannie Mae and Freddie Mac, which is a 30-year fixed rate loan. They do typically require at least 15% down, but most common is 25. And they do like to see, again, 6 months of reserve requirements set to the side. I also have a couple other unique programs available because Fannie and Freddie do have limitations on the number of investment properties that you actually own and have financed. So the theory behind that is this: is Fannie Mae and Freddie Mac are designed to help you start out growing your investment portfolio. Once you've hit properties of 10 or more that are financed, they really feel you need to be working with a commercial lender, one that's really familiar with the market within your area and understands the rent flows and how your market is and operates. Fannie and Freddie is a national firm, so once you get above 10, they really feel you need that special hand and understanding of the economy. But we do have options for those investors that have more than 10 properties, but yet they're not quite able to qualify for some of the traditional investment properties from banks. And they're what we call the non-QM loans, which stands for non-qualified mortgages. So the non-QM loans work this way. You'll need anywhere from 20 to 25% down. They don't require tax returns. There's no income documentation. The only thing they're going to use the cash flow from the investment property to qualify. So I'll give you an example. If you find a property that you want to buy and the market rents are $2,000 a month, and the mortgage payment after the down payment comes in at $1,800 a month, since you have positive cash flow, they're going to lend you the money for the home, no questions asked. The other option that they do is they'll go up to 100%. So on that same example, if market rents were $2,000 and the mortgage payment was $2,000 a month, PITI, they'll still lend you the money to buy that investment property and keep growing your portfolio. So those are some of the loan programs, some of the things that we look for when you're trying to obtain an investment property. Keep in mind, we have your Fannie Mae Freddie Mac. They do have max debt to income ratios of 45%. They have the fixed rate options, and you are allowed to have the seller pay some of the closing fees. Now, I will tell you that unlike buying your primary residence, Fannie and Freddie typically like to see you cover the closing costs as much as possible because they like a lot more skin in the game because of the type of loan that it is. And this is also one of the other investment non-QM files that we offer. We do offer a flip program where you could buy a distressed property, rehab it, and then turn it into a rental. That's a program that requires a lot more detail, a little bit more time, and we can get into those. But if you're interested in something like that, I'd be more than happy to talk to you about those as well. But that's any questions at this point?
I have one question. What's the
Yeah,
difference in your loan product versus a hard money lender?
sure. So your hard money lenders, what they're going to do is they're going to give you the loan. It's going to be at a very high interest rate, and they're going to expect to have the loan actually taken out. They're going to want their money back within a very short period of time because they're going to want to lend again. So with our loans, we're more of a permanent loan. So I've seen some of my property investors, what they've done is they've actually reached out to a hard money lender to acquire the property quickly and then come back to me. Keep in mind when we do a refinance of an investment property, there are some different guidelines we have to follow, loan to value changes, etc. So there are certain things that we need to watch out for when we are doing converting a hard money loan into a permanent mortgage. But we have done that from multiple times.
Oh, okay, great. It's good information to know.
Yeah.
So hard money means a high interest and short period, basically.
Yeah,
It's
it
hard.
it is hard. Yeah, and they're pretty demanding. As soon as you go past that due date, the penalties get pretty extreme. But that's the way that it works. But it works well. I mean, it is a nice vehicle that can be used, especially in today's economy because of housing market things going so quickly. Some sellers just want their money immediately, and you don't have a choice but to get to the hard money loans because it takes a little bit of time for us to process those traditional mortgages.
Okay. Well, thank you very much. I learned a lot.
Vandy, I appreciate your time and thank you so much for having this. It's great. And uh, at any point in time, if anyone's got any questions, I'm available. Please reach out to me.
Thank you. All right. You have a good day.
You
Bye,
too. Bye
everyone.
bye.